A quiet shift in Japan's bond market may be the pressure point that finally exposes how fragile the global debt system really is, and almost no one is prepared for what comes next. Something extraordinary is unfolding in the global bond market, and it's happening far from Wall Street. Japanese 30-year government bond yields have surged sharply, jumping more than a dozen basis points in a very short time. That move alone would be notable, but what truly matters is where those yields now sit at levels not seen since the late 1990s. For the first time in decades, long-term Japanese yields are beginning to close the distance with long-term U.S. Treasury yields. This narrowing gap is more than a technical detail. It may represent one of the most important macroeconomic developments of our time. For years, investors treated Japan as a financial outlier. Its economy seemed stuck in slow motion, defined by low growth, aging demographics, and persistent deflation. But that environment allowed Japan to carry an enormous debt burden with surprisingly little market stress. Now that framework is starting to crack. As yields rise, capital flows are being forced to reconsider long-standing assumptions, and the ripple effects could extend well beyond Japan's borders. At the center of this story is debt, lots of it. Japan is one of the most indebted developed nations in history, carrying government liabilities approaching 10 trillion. That debt load is not isolated. It exists within a tightly interconnected global financial system where major economies hold each other's bonds. Japan alone owns more than 100 trillion in U.S. Treasuries, making it the single largest foreign holder of American government debt. Any disruption to Japan's financial stability does not stay contained, it reverberates outward. To understand why markets are suddenly paying attention, we need to look at what's happening beneath the surface of the Japanese economy. By most traditional definitions, Japan is entering the early phase of a sovereign debt crisis. Government debt stands at more than twice the size of the country's entire economy. That means a significant portion of annual tax revenue is consumed simply by servicing existing obligations. For years, this imbalance was manageable because borrowing costs were extraordinarily low. But conditions have changed. Investors are now reassessing Japan's fiscal reality. Bond yields are climbing rapidly, and at the same time, the Japanese yen has been weakening. This combination, rising yields alongside a falling currency, is a classic warning sign. It suggests that confidence is eroding and that investors are demanding higher compensation to hold government debt, while simultaneously reducing exposure to the currency itself. Historically, this pattern has marked the early chapters of many debt crises. The key question is why this shift is happening now, after decades of relative calm. The answer lies in inflation, something Japan barely experienced for a generation. For much of the past 30 years, Japanese inflation hovered around zero and frequently dipped into outright deflation. Consumer prices were flat or falling, and the entire financial architecture of the country evolved around that reality. Low inflation made it possible for the government to borrow heavily at near zero interest rates without triggering immediate consequences. That era appears to be ending. Over the past 3 years, Japanese inflation has averaged close to 3%. While that number may not sound extreme by global standards, it represents a dramatic reversal for Japan. More importantly, it exposes the excesses that accumulated during decades of ultra-loose monetary policy. Low inflation allowed policymakers to delay hard decisions. Higher inflation removes that luxury. One of the most important tools Japan relied on during its low inflation years was aggressive quantitative easing. In simple terms, the government issued massive amounts of debt to fund spending, and the central bank stepped in as the buyer of last resort. By creating money and purchasing government bonds, the Bank of Japan suppressed yields and ensured borrowing costs remained artificially low. This approach worked as long as inflation stayed dormant, but once inflation takes hold, the rules change. Printing money to buy bonds becomes dangerous because it risks fueling even higher price increases. As inflation finally emerged, the central bank was forced to pull back. Bond purchases slowed, then stopped, and more recently, the balance sheet has begun to shrink as bonds are allowed to roll off or are actively sold. This shift turned the largest buyer in the market into a net seller almost overnight. Markets reacted immediately. With the central bank stepping away, bond prices fell and yields surged. Investors suddenly realized that demand for Japanese government debt was not as deep or stable as previously assumed. The result has been one of the fastest increases in Japanese bond yields in decades, pushing long-term rates to levels that would have been unthinkable just a few years ago. Naturally, this development has sparked concerns about spillovers to the United States. A common argument is that rising Japanese yields will entice domestic investors to repatriate capital, selling U.S. assets and treasuries to invest at home. On the surface, this makes sense. Higher local yields reduce the incentive to seek returns abroad. However, this explanation misses a crucial detail. The sustainability of debt matters just as much as the level of yields. Japan's debt to GDP ratio stands at roughly 240%, an extraordinary figure by any standard. Servicing that debt becomes exponentially harder as interest rates rise. Even modest increases threaten to overwhelm government finances and raise the risk of default or forced monetary intervention. In contrast, while the United States also carries a heavy debt burden, its debt to GDP ratio is closer to 120%, still high but far more manageable. This difference has important implications. Japan does not have the same room to allow yields to rise freely. If borrowing costs climb too far, policymakers may be forced to intervene again, even if inflation remains elevated. That could mean renewed money creation to cap yields, further weakening the currency. In other words, higher yields in Japan do not automatically translate into a safer or more attractive investment environment. When we adjust interest rates for inflation, the contrast becomes even clearer. Real interest rates in Japan remain deeply negative. Holding yen-denominated assets still results in a loss of purchasing power over time. In the United States, real rates are significantly higher, making the dollar comparatively more attractive despite its own long-term challenges. From a global investor's perspective, the choice is not between two equally flawed options. It's between a currency with structural weaknesses and another with even greater immediate risks. An analogy helps clarify the situation. Imagine choosing between two boats in rough waters. One has visible leaks but remains afloat. The other is already half submerged. Rationally, most people would avoid both and look for solid ground instead. In financial terms, that solid ground has increasingly been hard assets. This dynamic helps explain why gold has been one of the strongest performing assets recently, as investors seek refuge outside the fiat currency system altogether. Currency markets reflect this tension. Broad measures of the US dollar show gradual weakening over recent years, which has supported assets like gold, silver, cryptocurrencies, and equities. Yet when the dollar is measured specifically against the Japanese yen, a different story emerges. The dollar has strengthened, even as Japanese yields have climbed. This divergence highlights where stress is actually concentrated. Rather than dragging the dollar down, Japan's difficulties have, paradoxically, provided support to the U.S. currency. As investors reassess risk, the yen has borne the brunt of the adjustment. The result is a stronger dollar relative to Japan, offsetting some of the dollar's broader decline against other currencies. This is the real spillover effect currently playing out. For traders and investors, this environment presents both risks and opportunities. On one side, positioning against a weakening dollar can benefit exposure to commodities, metals, and foreign markets. On the other, a declining yen can serve as a hedge, balancing portfolios if dollar strength temporarily reasserts itself. This type of asymmetric setup allows for flexibility across multiple scenarios. If the dollar strengthens further due to continued stress in Japan, positions that benefit from a weak yen can appreciate significantly, cushioning losses elsewhere. If the dollar resumes its broader downward trend, assets tied to dollar weakness may thrive, while yen-related trades can still perform if Japan's structural issues deepen. The key insight is that these forces are not mutually exclusive, they can coexist within a well-constructed strategy. Stepping back, what we're witnessing is not an isolated event, but part of a larger transition. Decades of suppressed interest rates and expanding balance sheets created a fragile equilibrium. Inflation has disrupted that balance, forcing central banks to choose between currency stability and debt sustainability. Japan is simply one of the first major economies to confront this dilemma in full view of global markets. As long-term Japanese yields continue to rise and the yen remains under pressure, investors should expect volatility, not just in Japan, but across global bond and currency markets. The interconnected nature of sovereign debt means stress rarely stays contained. While the United States may appear relatively insulated for now, it is still part of the same system. This is not about predicting an imminent collapse, but about recognizing structural strain. The narrowing gap between Japanese and U.S. yields is a signal, not a guarantee. It tells us that long-standing assumptions are being challenged and that capital flows are becoming more sensitive to inflation, sustainability, and policy credibility. In times like these, understanding the mechanics matters more than reacting to headlines. Markets are adjusting to realities that were postponed for years, and the adjustment process is rarely smooth. Whether this culminates in a broader debt reckoning or a prolonged period of instability remains to be seen. What is clear is that the era of effortless borrowing is fading, and Japan's experience may be a preview of what others eventually face. Thank you for watching, and stay alert, because shifts like this tend to accelerate before most people realize what's happening.